Don't stop me.
Make a good deal, good deal.
Don't stop me. Don't stop me. Oh!
So as you know, we always kick off this event with our State of Digital Media. And my partner, Mark Birnbaum, and I are going to sort of walk you through some slides as to what we think is going on in the ecosystem. Pause for water. Okay, let's get into it. So last year, the theme here, can we start the clock here at 20? It was change. And we pictured all of these various leaders around across digital media who were exemplary of the kind of dramatic change that was going on in the ecosystem. Well, if we were to update that to this year, I think we would say more change. And basically all the same people. Think about it, right? Every one of these people and the companies for whom they represent have been sort of in the news this year. And the 800-pound gorilla is, of course, what is going on with the big tech leaders. Massive challenges from data breaches, platform abuse. We've got new data regulations to deal with, and of course, antitrust action. We have not seen a cataclysmic sort of focus on the tech world, and in particular as it impacts digital media, than what we've seen just in the last year. Several years ago, we're a full-on techlash, we're declaring it. A couple years ago, our good friend Scott Galloway came out calling for a breakup of the Big Four. And let's not forget, people, when he came out with that point, it seemed heretical. Are you kidding? Break up the tech companies? It seemed like he was a crazy university professor. Well, he is a bit of a crazy university professor, but that's besides the point. Turns out, you know, that same call has now been echoed from early investors in Facebook like Roger McNamee, and just last week, Chris Hughes, one of the co-founders of Facebook, came out suggesting the company was too powerful and needed to be broken up. And now here in 2019, we've got presidential candidates calling for the breakup of big tech. This is about as significant a focus on our industry, I think, as it gets. And yet, you know, the challenge is that these tech issues tend to get painted with the same brush. And yet, we believe there's a difference, right? The reality is, yes, there are horrific things, data breaches, things that violate election objectivity, and some of these antitrust moves. Those are material issues that need to be dealt with, and perhaps regulation is the right thing. What we lament is the commingling of that with this notion of the surveillance economy and anonymous tracking. We think it's an issue, needs to be dealt with, consumers need choice, but they're not the same issue. Of course, this time last year, GDPR came into effect in Europe and had a variety of effects, most of which, though, have been somewhat limited. We saw some companies just suggest it's not worth it. Let's just close down our European business, in particular on media. There's been 91 fines in GDPR. Now, these haven't hit the headlines because they're not significant. So far, it feels like the implementation of this law and the coordination with companies and even some of the fines, they've been relatively minor as they've tried to get the ecosystem to comply with the regulations. And at least by one study that we did with Prohaska, the opt-out rate, as it turns out, by consumers is actually incredibly low. So it calls into question as to whether, you know, the consumers are upset about privacy, or regulators and privacy zealots are saying consumers are upset about privacy. I think that's TBD. But the underlying impacts, of course, are much more worrisome. Of course, we're seeing regulation come here to the US. We've seen tightening data availability by the major browsers and tech providers, all of which we believe ends up strengthening the hand of the large tech companies, in basically increasing the walls on the walled gardens. We've seen both Google and Facebook implement measures to pull data back from third-party sources or partners, all of which, yes, may be done under the guise of privacy, but ultimately has an implication on antitrust as it strengthens their hand. And look, major tech fines, we're now up over 15 billion in fines, and it's had their impact on reputations, right? And Google not so much, but Facebook, dropped from materially in their reputation rank to a point where they are now just slightly below investment bankers. So that's pretty bad. That's pretty bad. Now, it doesn't seem to have impacted investors. I mean, their stock prices, even though they've gone through a swoon, have come back, and they're basically flat from, roughly flat, absent yesterday, from this time last year. So I say investors haven't seemed to care, but no. It's perhaps not investors. These companies have been recording phenomenal quarter after quarter performance in revenue growth and profit. So maybe the real message is advertisers haven't seemed to care, at least so far, about these issues. We're all aware of the duopoly, dominance in the ecosystem. Now, of course, the triopoly with the fervent position of Amazon. But let's not forget that white bar, right? The white bar, which is basically everybody else, is still is A, large, and B, growing. So that's who's represented by the folks in this room. This is overall, not all news is bad. There's pretty substantial growth, even if you account for like the next five: Microsoft, Verizon, Twitter, Snap, and Pinterest. We still have a growing other ecosystem. What's behind that growth? Clearly programmatic. We're now up to 82% of all display spend is done programmatically, and that's still growing at a healthy pace. These are all e-marketer numbers. Video is now half of display ad spend and growing very rapidly. We live in a video world. And of course, mobile is now 2/3. We suggested 3 years ago we wouldn't even be talking about mobile as a distinct category because mobile is basically everything. Now, as mentioned, programmatic was built on the back of third-party data. And yet, we now have a constriction in that third-party data brought about by data regulations, which all that does is make more important the notion of first-party data and the use of first-party data, which is a trend that we think we've been calling for and suggesting was appropriate for some time. Turns out this scrutiny has not prevented deals in the space. We've seen data-driven M&A persist regardless. Billions and billions of dollars just in the last year have been spent on companies that manage consumer data. And we note that even the ad agencies themselves have gotten in on the act. Dentsu with Merkle several years ago, IPG with Acxiom last year, and this year Publicis Epsilon. $8 billion by ad agencies to get into this data world really tells you something. In fact, we harken back 4 years ago to a thought piece we put out called Back to Mad Men, when we were talking about what we saw as the future of ad agencies. And in it, we had suggested that for ad agencies, in particular on the media side, they were suffering from encroachment from all these various players, from data marketers to technology companies, even insourcing direct with marketers. And the conclusion we came with, we published a piece in Ad Age about this. The conclusions and predictions we had suggested were, look, holding company mergers wouldn't, well, these are our 5. Let's see how we did. Holding company mergers wouldn't work. I think we got that one right. We haven't seen any more of those since. Tech acquisitions would fail from the standpoint of professional services mixing with tech. We saw a little bit of activity here. We think we got that one right. We had suggested 3 different paths for ad agencies: acquire data businesses. We think we got that one right because we've seen a substantial amount of activity, over $8 billion. Acquire tech services. Yeah, we didn't. We thought Sapient was an interesting move. We haven't seen more like that yet, but who knows?
S4 Capital is a very different model.
As you heard last year, Martin Sorrell was here talking about their approach, which I think will move more in the sort of tech services area. And then finally, we expressed the need for a sort of strategy and systems integration capability that either the consultants or the ad agencies could serve. I think the jury is still out on this. If it were ad agencies to perform this role, I think they'd need three things. One is they need to change their business model. Two is a question whether they have the right talent for this, and recruitment may be necessary. And third is trust, and we'll talk more about agency marketer trust at lunch, which we know has been somewhat fractured and needs work. So another challenge of marketers, speaking of marketers, is this notion that, okay, fine, turns out data is really important to be effective in this world. We very much have data silos, and they don't talk to each other. Enter probably the hottest category in the sector, the three-letter acronym CDP, Consumer Data Platform. And we don't get hung up on the initials. It's more about the functionality. What we're talking about here are technology businesses that can collect, unify, model, segment, and then ultimately syndicate data, third, first, all of it to inform almost every consumer touch point. And this category, we love shiny new objects and hot new TLAs. And of course, this category has garnered over $600 million in venture investments just since 2017 in the last 2 years. Again, the notion is to tie together the whole holistic sort of ecosystem from planning all the way through to attribution and back to planning, all centered around data and identity. And if there's one element of this sort of flywheel that's a little bit off, a little bit broken today, it would have to be attribution. We are simply not there where we need to be to have this be an effective data-informed marketing world. We've seen Amazon close the loop, right? Whether you arrive there at the shopping level and make your purchase, or you do a search. We know the majority of users start their searches on Amazon for products. Or now, with their very substantial display and media business, they're capturing users all the way from the top and basically creating that closed loop. So and with the phenomenal over 100% growth that they've experienced, we know that closed loops work. So how do you jury rig? How do you affect a closed loop in an open ecosystem? Again, multi-touch attribution. Turns out Wes Nichols was right 10 years ago. The question is, how do you capture not just last click, but all the elements of a consumer touch points? In fact, not only do we need to move from last touch to multi-touch attribution, I think we need to move to some notion of incrementality. I think you'll hear a lot more about this notion going forward, which is not just counting all the touch points, but actually figuring out which touch points mattered, because there are many touch points that turn out to be irrelevant. We've been talking at marketer conferences of late, and the message we have had is this notion of forest for the trees. What are the real trends in marketing you should pay attention to, because there are so many sort of shiny new objects. And one of the things that we suggest is follow the consumer, right? There are trends one can learn by following what the consumer's doing. And here's a couple of trends that we think are consumer-driven that give good insights as to what's going on. Direct-to-consumer and convergent TV. So direct-to-consumer, we came out last year with this presentation at the ANA called Fire Your CMO. Nothing gets CMOs more tuned in than suggestion that they should be terminated. Great tune-in. But it turns out that this story is really one for you guys. We call it a MarTech love story, because it's the techniques and technologies utilized by these D2C brands that are allowing them to be more effective. And more effective they are. We have seen relatively young startups garner double-digit market shares in a variety of verticals against category incumbents who had been building their brand equity for decades. This phenomenon, we think, is real, and it's pervasive. Our DTC LUMAscape now counts over 400 companies and represents over $20 billion in venture capital investment. This is the hottest new category in marketing and technology investing by direct-to-consumer companies. We sort of did an analysis and came up with, here's our sort of 7 sort of DNA elements of what these DTC brands are up to and how they differentiate. You know, obvious ones like disintermediating, you know, agencies, retailers, and wholesalers. But I think the important things for this crowd is the way they approach identity and customer relationship and the way they approach performance-oriented media spend. Our message at the ANA was, do not ignore this, traditional marketers. This is a real phenomenon, and there are elements here that which you can learn. And we're delighted to see that, yes, traditional marketers are taking this message seriously. Mark Pritchard has initiated a variety of strategies, from acquisitions to what they're doing, how they're managing vendors, investments with their incubator fund into DTC companies, and even launching their own. So I think the message has been heard, and we're seeing major marketers now try and take advantage of this. And as I mentioned, you know, one of those elements was acquiring direct-to-consumer brands. We have seen now, with last week's announcement of Edgewell, which is Schick, buying Harry's for $1.4 billion. Now $10 billion in the last 2 years at over 5 times, or approximately 5 times revenue. So these are garnering valuations well and above their underlying businesses. And of course, while they all started in digital, right? These are Instagram and Facebook sort of natives. They've moved beyond that to retail, to voice, to out-of-home, and yes, television. In fact, the growth of DTC brands in television has been one of the major trends that we're following. And why not, right? I mean, the conundrum here of TV is that for years we've talked about, you know, TV's dying and it's going to fundamentally change. And yet, year after year, the upfronts, which, you know, kicked off yesterday, keep getting stronger and stronger, so the business of TV is still vibrant. So how do you make sense of this conundrum? Well, we think it's a gestation that just needs to work its way through. So think about it as phase 1. Obviously, consumers, you know, have moved from watch whatever's on in one screen to multi-screen. We're long past that trend. Second thing that had to happen was major content investments had to be made in order to have inventory for this new addressable world. And we saw both in terms of content acquisition as well as corporate acquisitions, notably 21st Century Fox and Time Warner, and we believe more to come, have gotten the sort of the content investment side. Third thing was we needed technology, and we've seen a variety of strategics across the ecosystem focus on their CTV tech, either doing it organically or through acquisitions, over $3 billion in M&A deals just in that category alone in the last several years. So that was the third component necessary in order to be where we need to go, which is to now apply the digital attributes to television, so we can bring, you know, targeting and personalization and all that good stuff to the big screen where you've got brand safety and premium inventory. Of course, it's not that clean, right? Where there's digital video, there's addressable, there's OTT, there's linear, and what's needed obviously is a measurement capability and analytics in order to bring those sub-channels of the sort of CTV world together so that a marketer has a holistic view of actually how they spend their money in the channel. Meanwhile, as you're well aware in the modern press, you know, streaming wars are in full force. Netflix growth continues, you know, unabated, and yet we've now seen other media companies decide, you know what, this is so fervent a trend led by consumers that we're going to get in on the game. And Disney made the hard choice a couple of years ago now to launch their own Disney Plus channel. Of course, they've got a whole bunch of assets in order which to do that. Comcast, NBC has announced their own intentions. AT&T, basically lots of major players are deciding to get in on the streaming game, and even Apple TV Plus has announced. So a lot of attention being paid primarily on the subscriber, the SVOD side of the world. But don't worry, we've There is a vibrant opportunity with a rapidly growing OTT advertising marketplace that's sizable and growing rapidly. We see this with Roku's numbers. We see this with some of what Amazon is announcing in terms of their new IMDb offering in AVOD. So ultimately, and acquisitions, Pluto being acquired by Viacom and Cheddar being acquired by Altice have demonstrated that, yeah, we're going to probably rebalance the scales. There will be a big opportunity, not just in SVOD, but also in AVOD. Speaking of publishers, digital publishing has back from TV to sort of print has not done as well. You've seen the news stories around layoffs of some of the major, digital brands. We've seen write-downs by some of the, larger companies and their investors, fire sales even of some of these properties, and ultimately exits of some of these more traditional names, albeit maybe better termed philanthropy, since these are largely, billionaires, buying these properties, and we hope that will keep those fervent. And yet there are bright spots. Axios, doubling year over year. The New York Times just doing phenomenal growth for a 168-year-old company. We're delighted to see those, and of course we'll be talking about those later on. From a standpoint of emerging technologies, audio and voice we've been talking about, and artificial intelligence. Audio has really sort of come into its own, both from the digital side and the traditional audio side. We've seen a variety of acquisitions just in the last year where these players are sort of getting ready for this addressable future, and I think including the Cirrus Pandora deal. And I think a lot of this is driven by the rapid growth of podcasting, which has seen pretty significant growth, and again has led to some of these investments and acquisitions. Still relatively nascent from a total size perspective, but growing very nicely. And that's all despite the fact that Apple, of course, still is the platform for over 50% of that podcast listening. And of course, we've mentioned the smart speakers. These are installed. Now we're over half. The U.S. has smart speakers installed in the home, so watch this space in terms of what we think happens there for marketers. This is such a vibrant space, we decided to make a LUMAscape out of it, and so we are announcing the audio LUMAscape we published today that incorporates a lot of those players. Go check that out on our website. And then finally, before we talk about markets, AI obviously will be a major component. We think it'll be more like Intel inside, in the sense that AI should be informing a lot of what we're used to is the left brain stuff, right, like propensity modeling and predictive analytics. But what we get excited about is the capabilities of AI on the sort of right brain aspect of things, which is truly new to the market. A couple of trends that we sort of would suggest, maybe put the hold button on. Blockchain is a phenomenal technology. Its applications to marketing, we still haven't seen a lot of there, and of course understand that we're thinking about this from an M&A standpoint. And of course, we said years ago at the sort of when AR, VR was super hot that we'd suggest that people hold off from an investment standpoint because we didn't sort of see the huge opportunity. So I want to now invite my partner Mark Greenbaum to come up and talk about the state of the market, because that is going through change as well.
Great. Thanks, Terry. Yeah, so Mark Greenbaum, I run the M&A effort here at LUMA. Let's talk a little bit about the marketplace. We'll start with the IPO market. We did see last year a couple of MarTech players get out, actually traded quite well in the aftermarket. But since then, in 19, I think the market's been partying like it's 1999 again. It's been kind of the stampede of unicorns, large, high-profile, loss-making companies, for the most part, that have gotten out. Mixed results in the aftermarket, but a really sizable pipeline of these well-known names across the broad tech sector. But if we focus in on the MarTech and ad tech categories, not so much. Not a ton in the pipeline. I think consumer experience company Medallia is still contemplating an IPO potentially this year. But otherwise, not a ton we see for the public markets, which is a little bit surprising if we take a look at the performance over the last year. So decent year overall for the markets. NASDAQ up 11%. Let's look at the subcategories. there. And we drill down, look here, this has never happened before at DMS. We've got the two subcategories we focus on, ad tech and martech, number 1, 2 in the charts, up about 100% each. In martech, that's pretty strong performance pretty much across the entire category. Ad tech, a little bit different. If we take the Trade Desk out of the equation, you see the rest of the ad tech category, that is market cap weighted, down a little bit. So it does help to have, at least as of last week, a $10 billion market cap player in ad tech, kind of lifting the rest of the sector. As we look through the other categories, I think despite rumors of the demise of television, they actually had a pretty good year. I think a lot of that on the strength of Disney's stock performance. The big cap, whether that be the telcos, the digital giants, or the marketing clouds, which is most of the market cap on this chart, pretty much all tracked the market last year, while the agencies continued to struggle a bit. So that's where the public markets were. But let's talk M&A, self-serving, of course. But that does continue to be the primary source of scaled exits in the sector. If we break that down, ad tech has seen declining deal volumes. If we think about why that might be, we looked a bit at who's been buying ad tech. I mean, historically, we saw a fair amount of activity among what we call the internet originals and the social media platforms building out their stack. But as that work has been complete, and we sense increasingly some regulatory concerns, that's quieted down pretty much to a whisper. Telcos have been a little mixed in terms of their appetite, some mixed results there. So we see a pretty imbalanced ecosystem in terms of buyers and sellers. And as we've been predicting, I think, for a little while here, there will be some blood across the LUMAscape. And sure enough, this year, a handful of relatively high-profile bankruptcies already hit. MarTech, slightly different story, increasing deal volume. I think if we look at that buyer ecosystem, quite a bit more healthy. Combination of the marketing clouds, we've got a handful of well-capitalized, high-multiple players all competing, I think, for increased features and product sets, as well as we've seen private equity come into the market in a fairly meaningful way, and not just as value buyers, increasingly paying strategic multiples, even outbidding strategics in a certain process. So that's been very healthy on the MarTech side. So we kind of sum that up. What are we seeing there in terms of the differentiator from the key value drivers of growth, leverage, predictability, ad tech struggling kind of across the board there, while MarTech kind of has it in spades. The one thing that does give us a little bit of encouragement and hope is strategic value. As we talk to potential buyers, there is still that strategic value, which we kind of call the X factor, gives us some confidence that even across the ad tech sector, there will be exit opportunities for the differentiated companies. So that's what we've seen in the market. Thanks so much.